So as a mortgage professional, right, we try to time the market as best as possible. Hopefully most people invest in their business by subscribing to MBS Highway. You get this kind of commentary every single day. You can watch the market. But speaking to loan officers here, if the jobs report is a miss, the market is probably going to rally on this Friday, the day that this is coming out. Do you think that would potentially be a better day to lock, or do you wait until the 17th when you get the Fed rate cut? And do you think it could just keep getting better after that, or do you think that the market is going to kind of bake in, like we talked about, the anticipation of the Fed rate cut, especially solidified by a weak jobs number, if that's ultimately what happened today? I don't know. Do you have any thoughts on that?
It's a really good question, and I don't think there's a one size fits all answer, because it's going to depend on your client scenario, how much time that you have. Also, there's no guarantees here, right? I mean, you could have the Fed cut, but they could have a very hawkish statement and press conference where, you could actually see rates move a little bit higher, at least in the shorter term. So, my advice there would be to talk with the customer about it. And listen, if we get some weak jobs data, which I'm anticipating, and you see rates fall a bit where, it makes sense, I would probably capture that, because, there's certainly a chance that things don't go our way. There's no 100% guarantee here. And while I do think the Fed's going to cut, while I do think that is going to help rates, you might not have the time there. So it depends. But,
Yeah.
What's the old saying? I think pigs get fat, hogs get slaughtered,
Right.
right? If you're seeing some more attractive rates and it makes sense for the customer, you need to balance the risks there, right? Because it's not going to go down a straight line. Nothing does, right? But ultimately, I'll show you my forecast for rates, and it's hard to put a time frame on these things, but if we were to look over the next 12 months, I'll show you like what my low target is.
Let's wrap up with that, Dan. I think that's a good way to close out this conversation.
So I think we could see the 10-year get down, which, by the way, the 10-year right now is around 428, right? So actually very interesting is that yields moved up a little bit. They were down like around 422 or so. They moved up a bit today as we're recording this because the federal appeals court ruled against the administration's authority to impose tariffs. Now, this is most certainly going to get appealed in the Supreme Court. We'll see what happens there. But in like a doomsday scenario where it's upheld, which I don't personally anticipate that to happen, but if it was, we'd have to pay back all the tariff monies received, which would just add a boatload to our debt, which means we'd have to issue a bunch more treasuries. We'd have to then absorb that in the bond market. So based on just that fear, we've seen yields move up a little bit. But nonetheless, yields right now, 428 on the 10-year. I think over the next 12 months, certainly, I think we could see them come down to 390. Now, there's always a relationship, and I don't want to just give you a number. Like, here's where I think 30-year mortgage rates could go to. I really want to kind of walk you through this, right? So this is for several reasons, but a lot of them also dealing with looking at the charts and some technical levels that I think that they can get down to, especially if we have some momentum, Fed cutting, weaker jobs data, inflation after some tariff impact is remaining pretty stable. And there's always a relative relationship between the 10-year Treasury yield and 30-year mortgage rates. Now, normally, if you look through history, 30-year mortgage rates are about 1.6 to 2% above the 10-year. So what does that mean? Well, let's just use round numbers. If the 10-year is at 3, that means mortgage rates are usually 4.6 or 5%, somewhere in that range. But there's periods of time where this spread widens and narrows. Boy, after COVID and stuff, you had these things fluctuate. You had all the quantitative easing, the spread went down. You had the Fed hiking, the spread went up. Boy, at one point in October of 2023, you had the 10-year at 5 and mortgage rates at 8 and change. The spread was like 3.1%. So I say this because the spread has been narrowing. Boy, just at like the beginning of the year, it was like 270. Now it's pretty close to like 2.25, which actually, believe it or not, has been our target. this year. So I hope we're wrong and the spread continues to narrow, because that's a good thing for mortgage rates. It means that they, on a relative basis, are outperforming the 10-year Treasury. So if my target is 390 on the 10-year, and we continue to see the spread either stay at the same levels, or if it narrowed, the target will be even lower here. But let's just say it's right around 2.25. Where does that put 30-year mortgage rates? Right around 6 1/8. So that's our target here at Highway, is that we're going to see rates at a low hit around 6 1/8. Now, some people might have been hoping for lower than that, right? But I don't think the bull market in our industry is as far away as many people think. I don't think we have to see rates get as low as many people think to see our business completely change. So first off, rates have been elevated for the last several years. So you have more people buying at higher rates, but you know that in all of last year, 2024, there was 1.3 million refinances. According to ICE's data, which they're a little bit more conservative, where you have to have at least 80% equity in the home, save 0.75% in rate. If you get rates below 6.5% for at least a little bit of a period of time, there's 4 million refis that are available. But not only that, there is so much pent up demand on the sidelines. And even if somebody has a home currently with a low rate, maybe they have 3%, are they going to go to 8% or 7%, 7.5%? Makes it tough. But I think if we see rates get down to around 6 1/8, that will be enough for them to move. And remember, people are still having life events. Maybe they had a kid, they want the extra bedroom. So I do think seeing rates come down at that level will really spark refis, but also will get some more activity in the purchase market.
Well, I mean, I would have liked that number with a 5 handle. I'll be honest with you. I appreciate the perspective.